Drew Meredith, how are you, mate?
Very, very good.
Sorry, it's Drew Meredith.
Another strong finish of the week.
Another strong finish of the week. What's going on in markets, mate?
I thought you'd be taking off, the four annual leave days to give you a 28-day weekend. Market's not much. It just seems like last week. It's just, not much happening, not much news, public policy being announced on social media.
Wow, yeah.
But we've got another, I think you had the early crow last week, which
early crow?
In hindsight, I went pretty hard on you about.
Yes.
But it didn't take long for volatility to return to markets.
Hey, wait a second. You did accuse me of having an early crow. I had to figure out what that was. Stock market ended up the US market, which was the biggest allocation of my money, the stock market ended up by 8.6% higher for the week. People don't know this.
How much was it down the week before?
I don't know because I didn't have a lump sum the week before. But let's not think about that. But that was the best performing week since the beginning of 2023, according to our friends at Bloomberg.
If you annualize that, that's a 400% return this year.
Yeah, I mean, who knows? I'll just call up Chris Joy and ask him how to do that math. But I was pretty happy with that. You can't
complain.
Can't time the market, but
and imagine if you sold out.
Yeah,
it shows you. We talk about time in the market. You obviously time the market for the time being. It's. I don't think it's looking as great this week though, is it?
The Aussie market's up 0.8 at the time of recording.
All coming from gold, basically, the moment.
What's IVV doing? 5-day chart down 1.5. Ugh, I don't like down markets.
You wouldn't if you just put a lump sum.
Actually, that might be because IVV's
into an index fund.
That might be because IVV's in Australian dollars. Hold on a second. Let me have a look.
We're seeing it
1.45.
I can't see this stopping anytime soon. Yes, and I felt like every bounce back in the last 15 years, or probably my whole career, has sped up. The bounce back from the GFC took 12 years.
Yeah.
The bounce back from 2012 took about 3 years. The bounce back from pandemic took about 3 months.
Yep.
The bounce back from the tariffs took about 3 hours.
Yep. Soon you won't even know.
If you consider it closed at 4 and reopened the next day, there's only 3 hours of trading and it basically bounced back completely. It's just happening so quickly.
People will just glitch and it'll be over.
And I think we went into a bit of detail about why it's happening, why we think it's happening. But I can't see volatility slowing down at all. We've had a pretty consistent for the last 3 years that it was always positive, and you're meeting lots of clients these days too. You do get this kind of this story or this feeling where it's I've done incredibly well myself the last few years.
Yeah,
but it's when circumstances like this and when conditions like this hit that it becomes more challenging, harder to stay on course. I had a question yesterday, and the client actually asked me, will you tell me not to sell when I come to you and the market's fallen 30%? I'm like, yeah, that's exactly what we do. But it is knowing when, and if it continues and if it goes down as heavily as it did in the past, there's always this question that comes, I need to protect my capital. I want to sell. I want to get rid of some of my investments now. I think what people are looking for is someone to say no. But I also, when I answered that question, I was actually like, if you're saying that, I haven't done the work up front that puts you in the right position, that makes you understand all the assets we're holding, and talking more about a bucketing strategy now, because ultimately what we do is bucketing in the form of an asset allocation. Maybe it's overcomplicating it by calling it asset allocation, but making sure you're comfortable with all the other aspects and investments you're holding. So when that happens, you're not calling me. You're actually doing what most clients are doing at the moment, which is calling me to buy, not calling me to sell.
Did you find that lots of the Wattle Partners clients were buying?
Yeah, not necessarily buying, but a lot of them are more like, no one said I want to sell, but plenty of them said I'd be interested in buying, or what are your thoughts on buying at the moment? And given how quickly it happened, it was more like, I think we need to see where this is going before we make the decision and dive right in with a $100,000 lump sum.
Yeah, buy a Prado instead, he said.
That's leveraged.
This is totally off, because I was just Googling the S&P 500, and this is an interesting article from ETF Stream. So BlackRock unveils S&P 500 3% capped ETF. That's the headline. And I was like, 3% capped? Does that mean they're capping the upside?
Is it like an option collar or something?
No, I think they just kind of minced their words here a bit. They what they meant is the weightings are capped at 3%. So you can have variability of the weightings per security. But I was thinking about this. Is there an ETF that's kind of like an annuity? Like if you're a retiree where you're like, I just want 5% guaranteed, right? I could go to a challenger.
Yeah.
Or I could buy this thing, right?
I mean, the closest thing you get is like JEPI.
Oh, from JP Morgan.
Yeah.
What is that? That's the buy right strategy?
I think JEPI's the right one. But essentially, to guarantee an income, you have to give up growth.
Yeah.
Is essentially, and the only way you can guarantee an income is in equity markets is via options. Essentially.
Yeah.
So what I think JEPI is like is that buy right?
It's something like
better than me.
Yeah, I can't remember the exact structure of it, but I'm thinking it's a buy right strategy. So you buy I think it is.
Yeah.
But then you often get called away.
Yeah.
So I think, it's a bit nerdy, but I think that's what's happening.
Or they're selling something. Like there's a group called Talaria, you might have met, that sell puts. And if you're selling an option, it means you're getting that option income, and you can deliver an income of something like 8 or 9% from that option income, but it can also be eating away at your capital. So you're capping your upside, but you're getting that guaranteed rate of income because you're selling forward the shares that you're going to buy.
Well, that's because the reason I bring that up is like in a market crisis, typically those types of things become more valuable.
Yeah.
Like the options become more valuable, all those different things through uncertainty. It's interesting. Did you see that Elon Tusk, he...
we can't say the full name.
No.
But you're a Tesla driver.
They actually stopped sending cars to China. So they can still make cars at the Shanghai plant, but they're no longer sending cars to China, which is really interesting.
So US made into China?
Yeah. Because they would send the Model X and the Model S there,
which are the nice Model Y there.
Yeah. It's a whole thing, but apparently that Chinese people didn't want them anyway, so it's no big deal. But
they put a licensing requirement on NVIDIA. Did you see that overnight?
Oh, no.
So NVIDIA is it the H20 chips? I sound like I know what I'm talking about.
Yeah,
some sort of H20 chip to China now has to have a license to be exported to China. So this is the kind of the backwards and forwards is happening. And I saw that the Chinese government apparently told Chinese airlines not to settle on new Boeing planes. So you're seeing this very company-specific trade war impact. Obviously, we hope it'll be short-term. Apparently, Donald is still waiting for Xi to give him a call to negotiate, just to kick off those discussions.
I feel like this has been like if you're the top dog of a billion population country.
You call me.
And also
go on Discord or whatever.
You've modeled these scenarios, like you've had some of your drones model this scenario like a million different ways over the last 20 years. How is this going to play out? At what point? What do we do if this happens? I feel like a lot of that stuff's just completely playing straight into the hands of China.
I think Sun Tzu the Other War, that's Chinese. Book.
Oh, you want tariffs? Cool, no worries. We'll just tell everyone that Louis Vuitton handbags are actually made in China. Which I don't know if you've seen the news lately. It's been revealed that all of those brands, Hermes, Louis Vuitton, all those brands actually are not made in Italy, are not made everywhere else. They're made in China.
It's like they put together in Italy.
Yeah, like maybe designed in California, made in China, as the Apple iPhones say. But there was so it looks like there's been this, Mitch wrote about it in his market update this week. It looks like all the Chinese influencers have been told to go onto TikTok and Instagram and start telling everyone that you don't need to pay for these American brands and these US, European brands. Just go straight to the factory.
Yeah.
And it's in China, by the way. So it's like kind of like, it's almost like the government has instructed its population to be like, go and use your influence to just tell everyone.
Buy direct.
That these brands don't exist.
They'll take the margin that the US wants back.
Exactly, yeah.
It's kind of those unexpected and
Nike got smacked.
Company specific, and that was Vietnam, and Vietnam's trying to negotiate at the same time. I think and you're seeing it in Australia, and this is probably on the investment side, is how do you build a portfolio that's resilient to it? So there's actually quite a few. Not necessarily winners, but there's a lot of companies that have been doing incredibly well the last few weeks. Telstra, for example.
Oh, great company.
Wesfarmers, Woolworths, all these domestically focused businesses, because every Australian equity fund manager has to be, if they're active, they have to be invested in something. So what do? They go from the exporting companies, growth stocks, into the locally facing companies, and they have to stay exposed.
They just buy them up.
Yeah, but then apparently two of the bigger winners were not winners, just the least impacted are CSL and ResMed. Because the products basically that CSL makes most of their stuff in the US, I think anyway. Or they make it locally to the markets they're going to, so it's not exports. And ResMed's a similar case, whereas a lot of healthcare companies have been smashed completely because they're making it somewhere else and exporting into the country.
Nike down 43% in 1 year. It's now a yield stock. It's got dividend yield of 3%.
Is that a buy?
Price earnings ratio of 18. I feel like it's, how far does it have to go before someone's interested?
It can't,
Like that's, a year ago, Nike was pure growth stock, and maybe not a year ago, but that's fascinating. Here is the question for you. A few weeks ago on the show, we talked about how maybe this whole Trump-China thing is actually going to make tech stocks stronger. FANG, buy, hold, sell.
Buy. I think it's a strong, like I went to talk to Atchison's, the smartest people in the room, as I say, when I'm in the room. And I was like, would you buy an equal weight S&P 500 at the moment? And one of the guys like, well, why would you do that when the big tech companies are now on the lowest forward earnings multiple they've been on in like 20 years? Like, I can't remember which company it was. It could be Amazon or Meta. It was on a 14 times forward PE.
Let me bring this up.
Like, in what world do you buy an Amazon, like one of the fastest growing companies in the world, on a 14 times forward?
A lot of these tech stocks are actually looking pretty good. Meta, this is on the always trustworthy Google Finance data. Meta's 20, Amazon's 30, but that could be because it doesn't produce a lot of profit. Google, that's 19.
Backward looking too, not forward. Google.
Microsoft 29, but that's basically because it runs the world. What else is in there? Is Broadcom in there? Broadcom's
whatever they do.
No one knows. 80%.
And what's that cybersecurity one?
Palo Alto.
Oh no, the other one. Snowflake. No.
Not Snowflake. Let me just bring up Palo Alto. That's
Palantir.
Oh yeah, Palantir. Palo Alto is 90%. Palantir, Peter Thiel, Palantir.
491 times. Yeah, that may be that.
He's not that one
yet. That's up 23% year to date though.
But that's because that does a lot of defense, data, intelligence type stuff. People, they don't talk about that, but that's what they do. And so they're just going to, like, bad news is good news for Palantir, that's for sure. So that's probably the one counter-cyclical. Were you talking CrowdStrike?
Maybe it was CrowdStrike, yeah.
Let's have a
look. Is that the one that blacked out? And then took down
Microsoft while it was at it. No, it's got no PE, so we don't talk about that.
The ASX 200 is only down 5% this year.
Yeah.
Is that surprising?
Is that total return?
Yeah. Oh, that's just whatever Google tells me.
Oh, so it's truth.
The S&P 500, over under 10%.
Under?
10.1.
Oh, Jesus.
That was a tight over under. Down 10%. That was a stitch up.
Oh, gosh.
So it's still down 10%. You did buy on the right day and you probably made a solid, but it's still, for those people that were buying late last year over 6,000, they're still off 10, 15%.
But this is what I'm thinking is right now is a good time to tilt a portfolio to super dominant companies.
Yeah.
Whether it's not, whether you're looking at US, like just tilt to the companies that will always win, or whether you're in Oz and you're tilting to companies that are domestically going to win.
Even CBA's held up reasonably well.
Well, why, it wouldn't be impacted by this stuff. CSL obviously benefits because it earns US dollars. It collects a lot of its blood plasma and all that sort of stuff in the United States anyway. So there's a lot going for that. You've got a note in here in your notes.
Uh-oh.
Fed worried about inflation. Are you worried about inflation? I'm kind of in the back of my mind thinking I'm worried about inflation.
No comment.
Well, as the Federal Reserve nominee, Dr. Andrew Dermot.
I think any inflation impact from tariffs is going to be one-off. It's going to hit pretty quickly, and then it's going to, like when you have an oil price jump or you have the GST come in, it feels like it should be kind of short-term. It's really what is the impact, and what we didn't expect last time is what's the impact on supply chains. What did the pandemic and the Ukraine-Russia war do to supply chains? So if this impacts supply chains like what China are talking about, then that's where real inflation comes from, as opposed to just the tariff impact where costs go up for a quarter and then they go back to normal. They don't go back to normal, but you go off a higher base, so inflation disappears.
But
the Fed's worried.
But what could you say the same thing about COVID, and then COVID turned into like a 3-year
supply chain.
Everyone's worried about toilet paper.
I don't think it can be. I think we're more self-reliant than we were then, and it's not going to impact every single. And we still don't know. Maybe 90 days from now, and they're fully implemented. Exactly what he said. Even the penguins. Then I'd be worried. Poor penguins.
Penguins would be taking everyone for a ride.
But unless it's fully executed as it is, I don't think it'll have the same global supply chain issue.
Yeah.
And what you might see, I think that people have already talked about, is that the Chinese exports to the US will reduce, but there's no reason all these other countries can't just start buying Chinese goods directly.
Yeah.
And that's how the supply. So it's not like blockages in China. It's more like there's a blockage between China and America, and how do you get around that? Maybe we just go, direct to the factory like the Chinese are doing. Like, why wait for it to get to the US and have all the tax that comes with it, where we can potentially buy it direct?
Imagine like BYD.
Like the Rask merch.
Rask merch, yeah. Imagine BYD, like Beyond Your Dreams, electric car, competitor to Tesla. It's probably like, I couldn't have asked for a better set of circumstances to sell these cars to the entire universe.
Other than the US,
Other than the US, and just get my facial recognition tracking software in everyone's house. And China's like
political issues today.
China's like, boom.
Well, the new car makes you. I don't think it's got facial recognition, but if I kind of lean a little bit,
it knows.
It's the way it tells me off.
Yeah.
You get a couple of beeps at you. Yeah.
I've heard some of the ones in China actually are more like emotional based as well. They can kind of determine if you're frustrated and blah, 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 blah.
Really?
That's what I've heard of this. Yeah. I could be told. This is like a conspiracy on the show, but
I've got one of those faces though, so it probably thinks I'm always kind of angry.
Oh God, what's wrong with this guy? Yes. Anyway,
cheer up.
Chauffeurs raised $150 million. That's good to know. MinRes.
Chauffeurs.
Anyway, inside joke, Drew. Anyway, WAM raised $150 million. Good on them. Mineral Resources continues to sink. They were looking for 500.
Yeah. That was their
dividend one?
Credit equity income.
The monthly
product.
Income thing.
Yeah. So well below expectations, hit by the market. It's it's hard doing a blended strategy too.
When was that? So this was the Wilson Asset Management, huh?
Closed yesterday.
Oh, right. Okay. So on Wednesday, the 16th of April.
Wilson Income Maximizer.
So this is kind of like a number of the other LICs, except it blends credit in with shares for franking credits.
Yeah, with the ability, the 60% equities and 40% debt.
Does it have a targeted yield on the...
It does. It was with the ability, historically, it offered delivered franked income of roughly 6.5%.
So not fully, it wouldn't be fully franked because of the credit.
Back tested, of course.
Yeah. Classic. But no, that's pretty, I feel like that's a product that people would want. It's like, can you give me a hybrid, like it's kind of like a multi-asset in a LIC structure, so I get franking credits all the time.
Yeah.
Kind of makes sense.
But why wouldn't you, for some people, I think, but then you could just do it yourself.
Well, you could, yeah. But
without whether there's a bias in there in terms of the types of companies they're going to own, the types of debt. I'm always like, you could probably build your own annuity if you're able to view it that way by having a good diversified allocation in fixed income, Australian equities, real income.
But a lot of people don't want to do that, and they trust the WAM brand for various reasons. So, yeah, okay. In other news...
You're going to tell me about the chauffeur.
Two peeps from Mineral Resources, embattled company that does something or other. The two people that were appointed directors as the ASIC investigation is ongoing to previous rumours and issues at Mineral Resources have now left. And as it turns out, I saw an article from about a year ago. One of the people that were appointed to work on that project actually ran a donkey farm. That's pretty good.
I don't know where to take that. I'm pretty sure, did we do a MinRes or Pilbara bet? You're going to check the old Google, Alexa, whichever one you've got.
I definitely wouldn't have said MinRes because I don't know much about it.
Well, I just can't pick these.
So 5-year MinRes, MinRes got to $92 a share. It's now $17 a share. Pilbara, as they call it in Victoria, was $5 a share. It's now $1.30. So it's a tale of who's the biggest loser. I don't think anyone wins from that. Yeah.
Down 50% and 39%.
But the
respectively this
MinRes, there have been I don't know if you call them, I don't know, I'm not a lawyer, but like allegations, opinions. There have been opinions.
Alleged.
It's alleged opinions.
If you watch Bluey, alleged.
It's alleged. Okay. We should ask Bluey what he thinks. Yeah. Or she thinks. Let's get it real. Anyway, so that MinRes could have done things better financially behind the scenes with like relationships with insiders and so on and so forth. And there's an ASIC investigation ongoing, which...
Have you been asked as a witness? Is that why you're tiptoeing around it, or...?
Well, because I believe the investigation is about to come to head.
It's live. Yeah, of course.
I have... Being in the finance circles, Drew, there's rumours on the street. And
are there?
There are. And one of the things is that it's complicated.
Chris Ellison stepped down, yeah.
Anyone that knows MinRes knows what we're talking about, and it could unfold that it's maybe no good.
Yeah.
I don't know. I actually don't know, but I've just heard rumours that it doesn't look good.
But that's not even what's hitting the company. They started in iron ore and they went into lithium, and they've got a whole heap of debt that they're trying to get, and they're trying to get major projects up to like a really efficient level. It's similar to what happened to Fortescue. I can't remember what year that was. It feels like it was the early 2010s, where Fortescue was trying to get these massive, fantastic mines, but the timing of the market, the timing of the iron ore price nearly killed them. And I think there's obviously a bit of impact of that, but aside from all the corporate stuff at the top, the business is struggling because of the commodity price and
there's a lot of other stuff.
The timing of the cycle.
And I should be very clear. I wasn't like implicating myself in any information that may not be known. All I know is that I read the announcement that the two directors who may not be working on
who just joined left,
trying to uncover what's happening, have since left.
Yeah.
Actually, I'll quote an article from Mitchell on our Rask media site.
Always put someone else in it. Good idea.
Yeah, thanks, Mitch. Mitchell Rask, head of First Management. Where is it? Here we go.
Well, there was a class action started a week.
I love this. Yeah. I love this paragraph from Mitch. Personally, I don't have a lot of experience with resignations. A few years back, I became the treasurer of the Brunswick Bowls Club. I asked a friend who was the CFO of an ASX-listed business if he had any advice. He only had one piece of advice for me. Quote, when you look at the accounts for the first time and you don't understand them, resign. I just thought, check out Mitchell's daily shenanigans.
The CFO of an ASX-listed company.
Over on raskmedia.com.au. Mitchell is actually writing daily. It's just a really good writer. It's so good. In other news, WiseTech also, things have happened. I did buy shares this week for full disclosure, and the next day said bad things happened.
I mean, bad from what perspective?
There's a lot of moving pieces on that.
And there's a lot of coverage about these companies at the moment, which is like which
is partially why I bought it.
Founders, both these issues are to do with the founders, and these two founders have basically had ultimate control of these companies for like 20 years now.
Yeah.
WiseTech was Richard White. I stepped down as CEO, got brought back on.
Yeah.
Reinstated a salary, but in a new role, Chief Innovation Officer and Executive Chairman, got his $1 million a year back, still the biggest shareholder, and locked in a 10-year contract at the ripe old age of 70.
Yeah, that's crazy. I didn't think he was 70. He's still sharp as a tack, though.
Where people were calling for them to both leave, which, I mean, it's how you navigate this kind of governance part of ESG as a professional fund manager I think it would be incredibly difficult.
Is he really 70?
Yeah. I wasn't like, I don't like to comment if you on looks or anything, but
yeah. If you watch the AGMs or you watch him do a product presentation,
he's sharp.
Gosh, he is one of the best in the country easily, and he's 70.
70.
If I'm even alive at 70, let's be honest, but if I'm half as witty and like sharp as he is, I would be very grateful for that at 70.
Oh, I thought you already. No, sorry.
I'm not halfway there yet. Anyway, gold at another high.
I was saying he's the former executive chairman.
Richard White?
Yeah.
But he's correct, right? Because he was a CFO, but there was a chairman.
I think he's exec chairman now.
Okay, cool.
Yeah.
Gold at another high. Growing recession risk. Rate cuts in May. Bet your mum's house on it. That is it.
No comment.
Okay.
The Fed did come out and scare the market by saying, literally last night, that I think they were asked a question as to whether they would be providing the Fed put, which is, the interest rates cut to support the market. They said no. N-O.
So basically what Drew's talking about is when there's a lot of uncertainty, everyone, if they're like, geez, this guy in the White House, he's pretty out there. Federal Reserve, can you save us? And they're like, no.
They actually said no. I don't think they've said no very often.
Bring us stability.
And that's why the US market was down pretty heavily overnight, but the Aussie market's up because everyone's rolling back into gold. Again. This thing just keeps going.
The first question this week comes from Dean. We are getting a lot of great questions lately on the Investors Podcast, Retirement Podcast, Finance Podcast. It's all happening, which is wonderful. So send your questions in via the link in your podcast player or in the YouTube description. The one that says ask a question, select the Australian Investors Podcast. None of the answers that we give here on the show are personal in nature. You may send in a funny name and win a prize, but we also like a funny name because we want to remind you that we don't know your needs, goals, objectives. So make sure you reach out to a financial planner, like say Drew here, before you act on the information. If we talk about ETFs or super funds or whatever, they have a product disclosure statement or PDS that is available on their website. You should read that before investing. Whew, okay, disclaimer done.
This is a reference to old school, is it?
Dean says, when it comes to defensive assets, why is there a tendency to allocate them as a percentage of overall portfolio, then build a defense position based on the portfolio owner's annual expense requirements? I think this is a fantastic way to think about investing in portfolio construction for what it's worth. It goes on to say, for example, 2 years equivalent of expenses in defensive assets and the balance in growth assets based on the risk profile. So this is effectively what financial planners do, Drew.
Yeah.
You have, what is your goal? Short, medium, long. If there's a goal like I'm going to buy a house next year, you don't obviously go and pop that into
equities.
Yeah, a leveraged fund like GGUS. We'll come back to that. You would use that. You would effectively apportion that part of their financial situation in lower risk investments that meet that goal, and then you have that longer term bucket, which might be like intermediate, and then moonshots maybe.
Yeah, of course.
So you kind of do this, right? But it's just not always as eloquent as this, as Dean's saying, because this is a good way for anyone to think about building a portfolio. This is it's very eloquent.
I mean, there's the thing here is that there's no perfect solution for everyone. So what's one person's 2 years is another person's 80% of their portfolio. So how do you make the rule that works for everyone? And ultimately what you're kind of talking about is this bucketing strategy. And my first comment on this was why it isn't so simple is that even defensive assets carry risk. So you have to there's a number of decisions and a kind of framework you have to go through to get there. But so the way we think about it is we always start with finding the person's number, and that is their cash allocation. And that's, we talk about cash, that's the cash in the bank, how much they need in the bank, and you'll be finding this out. If it goes below a certain amount, they freak out and they feel uncomfortable and they're looking at their portfolio more. If there's a certain amount of cash in the bank, it could be 6 months, could be 1 year, whatever it happens to be. And then you start building your defensive and growth allocation from there. And I think why it isn't solely linked to the annual expense requirements, we've kind of tried that in the past, is that the role of these lower risk investments isn't solely to provide an income. It's also to hedge against
rebalance.
Exactly. Hedge against the risks that's happening. If you didn't hold bonds, even though there was a lot of media about bonds being bad in the last 3 weeks, if you didn't hold bonds, you had nothing to either rebalance or to protect your portfolio. And if you're just holding enough cash to put into to fund your expenses, then you don't have the opportunity to rebalance at different points either. So I think we build it into an asset allocation as well as having that upfront emergency cash account or backup cash account question.
There are two approaches that I often see financial planners use, but they all end up in the same destination, which is a layering strategy. So like income layering, different levels of risk and whatever to meet their goals. And then there's the bucket strategy, which is instead of the layers, it's sideways. It's like first bucket, second bucket, third bucket. And a lot of times, I imagine your clients too would have like 2 years worth of expenses in cash and or term deposits or something like that, where it's like, I have liquidity, but I have income. I have liquidity, but I have income. So that second bucket can have a bit more balance or whatever. And then the third bucket's like, maybe I own a property, maybe I own a business. That's kind of that third bucket. And they all feed on each other. It's like one trickles down to the next, which trickles down to the next. So like you have a diversified portfolio at Wattle that in many instances for your retirees produces tax-free income. That then trickles into their everyday living expenses or a different investment portfolio and so on. This is a good question though. I think if people are out there wondering like all this stuff about 50% this, 20% that, just start with what do I need to cover?
And you can usually like reverse engineer that into an asset allocation, which I think people can tend to forget about. And I think the key there is that when you're going through that conversation with your advisor or when you're building your portfolio at the beginning, it is having a conversation about what your income needs are rather than just being slotted in immediately into a risk profile that says you're 35, 65. That could be all right once you've got your allocation to lower risk assets. But ensuring that's not the starting point, that's the ending point, and it's been adjusted for all the way through, which can be a bit, at scale, advice can feel a bit like it's predetermined outcomes. We're very much about having detailed conversations up front that work out your income needs and adjusting. That's why we have, and it's probably strange, the more I explain it, there's too many options, but we have one where you can pick a risk profile. We have one where you can pick every single investment. And then we have one where you can control the asset allocation. So you can actually buy Australian shares, international shares, and build your own asset allocation. The advisors can build that with the client, which is, I think, is quite rare and unique. And I thought it would be all, risk profile, but most of the advisors are working with clients to tailor asset allocations more closely if they have multiple, if you've got investments in your own name, investments in super, being able to pull those levers, which allows you to be more tailored around your asset allocation outcomes. Yeah,
that's interesting. Bit of housekeeping I just forgot to mention. Number one, Monique is famous, our producer. She's famous. Number two is that...
viral? Or
both, I guess. Number two
Do they still say that?
Just struggling. Number two is the Dizzy Rascals portfolio.
Can we point out is there a link we can provide to the post to get even more?
I don't know if she wants us finance types knowing about it. But so Monique, podcast manager, has appeared many times on the Australian Finance Podcast. Took some good photos. So shout out to Monique. And that went crazy over on social media land. So good on her. Turning to our portfolios, there's a bit of housekeeping that are our fake funny portfolios. They're not like
we don't have to do
portfolios.
This one.
Dizzy Rascals down 8%. This is the best one, chosen by Monique, and responsibly it's all mine, is down 11%.
Where do I find those if I was interested in looking at how
raskmedia.com.au/portfolio. raskmedia.com.au/portfolio. Everything portfolio down 12%. So we're neck and neck, you and I, to determine who has the worst portfolio so far, Drew.
Really?
The community's beating us.
We are very close. You've rounded me up, 11.97.
My position in XRF, according to this fake portfolio, brought to you by Navexa. Track your portfolio, track everything. We're actually working with the Navexa team to bring you a consolidated dashboard. So if you don't use one of these fancy tools, you can get tax reporting, all of your unlisted assets, your listed assets, all synced to one place where you can get a consolidated view of your wealth. It's going to be awesome. That's over at navexa.com. Anyway, we'll let you know when that comes up. My GGUS position, which is a leveraged US stock market ETF, is down nearly 30%.
You said it was going to be positive.
Yeah, it was. It was for about a day. It wasn't going to be positive, but it came it bounced 20%, and now it's just capitulated. Anyway, GGUS.
I lost money on Pro Medicus too.
Yeah, FANG down 15%, Home Depot down 13%. RPM Global, which I'm optimistic about and could even see myself buying shares in, down 18%. XRF Scientific, which is my micro cap of the day, is down 16%. Also one that does mine testing, mineral samples. It's a really, really, really good small cap business, down 16%.
Lucky we didn't top up when we had the...
Well, Greg over on the Rask community, shout out to Greg, he was like, are we going to do the thing that we thought we were going to do, which is every quarter we can sabotage each other's portfolio with one move? You'd probably just be like, just keep it as it is.
Yeah. Buy more sabotaging itself. I'll in-specie transfer Tesla to you.
KKR in the community portfolio down 32%. The mighty Vulcan, which has staged a bit of a comeback, is only down 18%. As I look across the portfolios, Soul Pattinson and Combank are the two best across all three portfolios.
The only holdings that are up.
And Tesla is, in percentage terms, is by far the worst at 42% negative. No one could have predicted this, Elon Musk.
They'll come back. I was watching
everyone
For
was
All
like,
Mankind at the moment. Great show.
You know what is? I haven't seen that. What's that about?
If Russia won the space race and the space race continued to expand, that's referring to SpaceX. So it's like SpaceX but funded by governments.
Yep.
Very, very good.
That's good to know. What's it called again?
For All Mankind.
For All Mankind. Yep. That's great. You know what's great is all of these conspiracy theories that are coming out about Elon Musk and Donald Trump trying to time the market. No one on planet Earth has lost more money from Donald Trump being in the presidency than Elon Musk. He has lost probably $100 billion, I'm going to say by now. It has got to be crazy whatever his net worth has fallen, because there has been one massive loser, and that is Tesla. And then the second massive loser is literally every tech stock and big company in the US, SpaceX included, I'm sure.
Yeah.
So I can't see how anyone could ever possibly justify Elon was going to benefit from this.
Unless he was short on it.
Yeah, unless he was short on his own self, which, who knows. But he's definitely doged himself, that's for sure. Next question comes from Putting on My Bucket Hat. Thanks for the great content on your podcast. It has helped enormously to give me confidence to start my investing journey. Oh, and you mentioned that you are using a bucket company to invest, including the 100K you recently put in. Can you explain why you chose to use that vehicle and what are the advantages and disadvantages of that strategy? So this may require a little bit of understanding of something called the tax structuring. So most business owners that have set up their businesses directly, they don't stay in what we call like a sole trader status. That's where you have an ABN and you can bill for work. A lot of subcontractors, tradies use a sole trader structure.
Yeah.
One of the big problems of that is that if you are sued, if you're an electrician or a plumber or something, your personal assets are on the line as well. So then most people look at companies, and companies are their own legal individual, if you think about it like that. Like they have their own tax rate, they pay their own, bills and expenses, and then you can get a dividend or you can get a salary from the company. But then there's another structure, which is a family trust, which is what most tradies that go on to produce bigger businesses hold their shares in. A trust is an entity that can hold onto assets for you. So what happens is they hold assets like cash or shares or something, but then any of the income and the profit and losses go through the trust and end up somewhere that gets taxed. And normally that spot where it gets taxed is either another company or individuals. So in the case of a family business, which is the best way to explain this, imagine an electrician has 10 people working for him or her. They have a company called Electrical Proprietary Limited, and it pays wages, it generates invoices and does all that. The money that the company pays out in a dividend goes to the family trust, and then from the trust, that income can get sent to the shareholders who may be, to the beneficiaries that may be Drew, myself, maybe husband and wife duo, might be something like that, and they're taxed. But what happens a lot of the time in meaningful sized businesses is there's another structure called a bucket company. And a bucket company is effectively where you just take the money that comes from the trust, and instead of sending it to an individual like me, Drew, Monique behind the screen, it gets sent to another company which pays its own tax on that income. It gets its name. The bucket analogy is like when you don't know where to put it, you just put it in the bucket.
Yeah.
There are lots of pros and cons to this. You have to be, a lot of people hear me talk about this and they're like, oh, so I'll just put everything in this bucket company. Well, the ATO is not that stupid. They then tax you at your individual rate if you try and dodge the tax. That's just totally not legit.
It's a tax deferral mechanism, not really a tax saving. Because if you're paying a distribution into it or any income that you get, so the income you get from your $100,000 that you invested is going to be taxable at the company tax rate.
Yeah.
And then for you to get access to that, you actually have to pay yourself out a dividend or a distribution,
which then you're going to be taxed on,
which you'll pay tax on as well. But you get franking credits because you pay tax within the company, similar to any other company.
Yep.
So what I see is a lot of people on medical professionals, lawyers on higher incomes use that bucket company from their 50s to 60s, and then once they retire, you start paying out the dividends and distributions from it.
Yeah. One of the things that I will caution people, just because I know you would have said it next, which is that if you are a lawyer or a doctor or someone in a white-collar architect, you could be even a trade, not so much a tradie, but there is a particular rule called PSI, which basically means that you can't just be like, all right, I earn $1 million a year. I'm just going to just invoice it all from this fake company and that will pay the tax, not me. It doesn't work that way. You'll still get stung. So there is a particular test, and you'll know this, Drew, for PSI, which is effectively that the company that does the billing and earns and generates money has to have assets and has to have like an actual business. It can't just be like a shell.
Yeah.
But I was chatting to a really impressive founder not too long ago, business owner, whatever, same difference. And his business turned over, he had 2 or 3 different businesses, probably $40 million. And he was one of a few shareholders, and he was personally drawing like $1 or $2 million from this company, which is fantastic. Not many people have that, right?
Yeah.
Not many at all. And I was like, oh, you just have your bucket company and your family trust. He's like, what? I'm like, where is your accountant to explain literally the hundreds of thousands of dollars of income tax that you are paying for what reason?
Yeah.
So like even
sometimes overcomplicating.
Yeah. In the early days, people do get sold into SMSFs, family trusts and all that sort of stuff. But the best person to go to is an accountant. If someone is listening to this and you are like super into accounting for investors, like you are like, I love accounting. I actually reach out to my clients. I don't wait for them to email me with a question. If you're one of those people, please reach out to us. We are always looking for good accountants.
Yeah, for sure.
Our community just needs good accountants, like actual people that care about the work you do, not just like, what's your tax return done?
Yeah.
Like if you actually want to strategize, like I want to hear from you, seriously. Anyway, great question.
The big things there is you don't get the capital gains tax.
Yeah, that's important.
Discount for assets held through the company.
Yes. Actually, there should be one extra thing that we should say here too, is that there are a number of other pros and cons to this. About the company, what happens once the money gets in the company. So people will be like, well, okay, money goes into Bucket, but what does Bucket do?
Yeah.
Well, Bucket can open a bank account. Bucket could invest in another company. Bucket could open a shares account and go and buy some shares of BHP or whatever it wants to do. So the actual company at the end, the Bucket company, it's not usually, and it probably shouldn't be legally, used to run another business. It's just used to receive the money and hold on to it.
Yeah, or lend it back to the business. Not lend to an individual, or you can lend to an individual, but that would be a whole other episode where you talk about Division 7A.
Yes, but there's a lot of, this is what in finance, this is what we call structuring, and good financial advisors and accountants know all about it because it is like the big area, to be honest. Anyway, we should probably answer. We've probably got time for 2 more questions, I reckon.
I'm going to start thinking about a dad joke.
Start thinking about a dad joke. Okay, this is another question. It's almost exactly the same as the other question. Interesting. Okay, what about this one? Okay, this is interesting. This is more a question about running a financial planning business. This might be interesting for some people. We'll focus on this one quickly. So this comes from Andrew Derrimouth Jr.
Is that right?
Yeah. It's no, that's his legit name. It's on his birth certificate. He's provided that. So maybe it's Andrew Derrimouth Sr.'s son.
Really?
Yeah, he said that.
God.
Or she said that. I don't know. I have recently finished my grad diploma of financial planning. I'm stoked. And I'm looking to get into the advice business and work towards my professional year. If you were just starting out in the industry, what tips would you give yourself? I know there's a lot of talk about wealth transfer and growth of younger clients getting advice. What approach would you take? Would you consider going to a company focused on retail type of clients or family offices with very large amounts of money? What would you do if you were a young person starting out in the financial advice profession, Drew? Just put yourself back like 45 years.
No, like it couldn't have a better market and environment to be going into with any level of interest in financial planning. I used to say I did it, I went to Commonwealth Bank. Like, go to a big firm, they'll teach you, they'll pay for your study, all that sort of stuff. No, don't go to a big firm. Literally, everyone is looking. Every financial advisor I meet is looking for staff, whether they're like learning to be financial advisors, already have experience being a financial advisor. People are desperate for new staff. Yeah. So it's no better environment, and getting started on that early, getting involved, reaching out to as many as possible. There's plenty of networking events that come up as well in that sector. And even if you can't get a job in the right one to start with, even in financial planning, you get somewhere like related to that can be positive as well. But it's just get out there and then start getting get some involvement in investing as well, whether it's running a paper portfolio like we are, and start focusing on increasing your knowledge. I find a lot of financial planners that come into our business have very limited investment knowledge. Not just in our business, but I think generally the education around investments is very limited.
In the graduate diploma, there's only one unit on investing.
It's all on everything else. Where a lot
Which
of
is fair because there's a lot of other stuff.
Particularly with retirees, a lot of your conversations around investing. Not that you need to know everything, but you need to be able to talk and know what you do and don't know. So
and learn from the others in the business.
Do a bit on investing, and then just seriously try to find any jobs you can. Look at boutique, try to find companies that you can relate to, that seem to be the niche you want to be, but don't think like you have to find the perfect niche or the perfect company straight away.
A lot of people are worried about, like they hear us talk about this sort of stuff and what we do, and they're like, oh, that sounds pretty cool. I like that sort of finance stuff. And they think they have to take a huge pay cut. A lot of the times now, so if you're working up to be an advisor, the best thing for you to do, in my opinion, is to work in what we call a CSM role, which is like client services. It's like you're interfacing with clients, or secondly, in an associate role. So this is like where you work normally with one or two financial planners. You do the meeting notes, you sit in on the meetings, you summarize things, you help prepare the statement of advice, and you do a lot of that kind of admin-y type stuff. I would say, even in some of those roles, if you have life experience, you can be looking at a lot of money, like relatively speaking, for a new career.
I hate it when you talk about it.
Yeah, but it's like you can be looking at serious money. Like I was chatting to someone the other day, actually a potential client of ours, and she was like, all I do is listen to your finance podcast. I've been doing it for 4 or 5 years, and I feel uninspired in my job. I was like, well, go and get a job at a financial planning business and earn probably the same or more of what you're currently doing. Difference is you'll love it.
Yeah.
And they'll pay for you to study. So
exactly. There's never a better time. Like I think even firms that aren't trying to grow are growing in advice.
Yeah, absolutely. And if you're listening to this and you have done your financial planning grad dip, maybe go and finish the masters while you work, because then you can do the electives in investing. But reach out to either one of us. Seriously, like we have a need for an associate role right now. So reach out. Seriously, might not be right for you, but anyone listening to this, just send us a message, because we are looking for good people. All right, one more question, Drew. Which one should we? Oh, this one here. Hello, team. This is from No Equity Man, and they've spelled equity with EQWITTY. No Equity Man. Hello, team. I have a play portfolio which I plan on growing. I have in the portfolio
a real portfolio, but they're playing with it. Yep.
Yeah. Is it? I have a play portfolio which I plan on growing. I have in the portfolio AFI and Solpats combining 23% of my portfolio. If I am to use a core and a satellite approach, would you make this part of the core, or combining it with like an ASX 200 ETF, or make it part of the satellite? Also, I noticed on Vanguard's website, the fund share price compared to the ETF share price is a fraction of it. Is there a reason for this? For example, VAS is $94 and the mutual fund's $2.62. Your show has been an awesome listen. I think that's two different questions. Let's start with the core and the satellite. If you deal with this a lot, they probably have AFI or Solpats or CBA or whatever. What do you think?
I mean, your core can be anything you like. So the one thing I'll say this week is it depends.
Wow.
Like I've met plenty of advisors and clients that have a core that's 5 active funds.
Yeah.
I've got our preference is like your core should be broad index tracking and very low cost. So our core is an IOZ, IVV, a VAS, whatever it happens to be. So very broad.
Yeah.
And if you're going for that low cost index like core, You could make a case that AFI probably sits in there. It isn't overly active. It holds basically the biggest companies in Australia, and that's makes some sense as being in there. Exactly. Soul Patts, I think, I don't know it as well, but I feel like it is more of a satellite holding if you're viewing this as broad-based exposure, because it does have multiple business lines, and it does include things like credit as well as equity.
Yeah, I think the problem with Soul Patts is that even so that people get mixed up with Soul Patts and LICs.
Yeah.
The difference with Soul Patts, and I feel like this is for what do we try and do? I agree with everything.
Soul Patts an operating business.
Yeah, I agree with everything you just said. Is that in your core, you're trying to be low cost, diversified, etc. Soul Patts is diversified and it's run very frugally, so it seems low cost. There's one big difference is that when you look at Soul Patts, you get a share price, and that share price has price earnings ratios and all that sort of mumbo jumbo. So it can be overvalued, undervalued,
Not just
undervalued.
The values of the
and
LIC.
not like a LIC or a better still an ETF or a managed fund, which is like mark to market. Like every day it represents the fair value of what's inside.
Yeah.
So if you were to say have VAS next to Soul Patts, you'd have VAS as kind of like just bubbling along, and then Soul Patts is bouncing up and down. It doesn't mean that it's good or a bad decision, but I've thought about putting Soul Patts in our portfolios. But then I've got to figure out if I put Soul Patts in our portfolios today, and say, I don't know what it is, but say it's like $20 a share. And then in a month, a new investor joins us and they're getting it at $30 a share.
Yeah.
I haven't really helped them control that experience, because now they're getting it at 50%
more than what it was before.
What the guy just, or the gal that just got it, right? So now then it could fall. Whereas an ETF, yes, it can rise and fall, but it's much more subdued in the way it moves. So there's more volatility. Does that make sense?
Yeah, for sure.
So I think about that a lot.
A LIC is a combination of all the ASX listed shares under it. Soul Patts is a combination of some ASX listed shares, some unlisted companies, some private equity, some private credit.
And then the decisions of the management team ultimately of just the company itself.
So the PE is irrelevant for AFI, but it's relevant for Soul Patts.
Yeah, exactly. So I should have just said that.
Yeah. I'm usually the one that blabbers on and can't get to the point.
Yeah, well, Soul Patts is up 10% in the year, not including dividends, 2.7% fully franked dividend yield. It's up nearly 100% in 5 years. It's a compounding machine, Soul Patts. I would happily hold Soul Patts in the core. I know I just said all that, but I would happily hold it in the core, much like Wesfarmers, Brickworks, probably similar, maybe a little bit less, or in the satellite. I think it's a wonderful, wonderful business. I think the Milner family have done an absolutely stupendous job of running that business for multiple decades. It's much like, I think it's even better business than like CSL and all those, because those have done really well. But this is something that I would happily give to kids. I'd be like, here you go. You'll be fine. It might be a bit of a volatile ride. Like, for example, coming back to the volatility, Soul Patts out of COVID hit $40 a share. Then less than a year later, it was $23. Yeah. So like, you don't get that with an ETF. That's the difference. But the trajectory is right. So we've come to the end of the day's show. We've got to do your dad joke. I'll give you a score. We've got to reward people that wrote in today with the Value Investor Program available on the Rask website. If you wrote a question in today and it got read out, you do get a $499 course for free. Just write into us on any of the Rask websites and say, hey, I'm Andrew Derrimouth Jr. Andrew Derrimouth's my dad.
I do. An illegitimate child that I don't know. Just
Dean,
FYI. Putting
him on my bucket hat. No equity, man. I love those names. Write into us and we'll give you that course for free.
And a book.
And a book. You get a book.
Yeah.
It's a great way actually to take your knowledge to the next level. That Value Investor Program is comprehensive, to say the least. It does focus a lot on like company valuations and it's really technical. But it also, at the very beginning of it, I actually talk about a core and a satellite and how to actually build an ETF portfolio that combines with shares, that combines with many funds. So go and check it out. It's actually really good. And it's probably tax deductible. Drew, Director of Wattle Partners, Drew Meredith, that's you.
I reckon Mon's going to laugh at this one.
It's going to take a bit of work. She's famous now.
Yeah.
Go on.
I went to buy some camouflage pants the other day. Couldn't find any.
Oh. Well, we got a smile.
You can laugh. Yeah, it's very hard to get a laugh around here.
That's pretty good, mate. That's a good 7 out of 10. For a dad joke, that's of quality.
You can understand it without thinking too much.
Yeah, that's very good. So Drew Meredith, that was a good bit of fun. Catch Drew on LinkedIn, YouTube, wherever you get your social media.
Get those comments and
get in
away.
there. Let him know. Have at it, people. And send your questions in for next week. We absolutely love the banter. If you do want us to do a bit of a takedown of each other's portfolio, totally fine with that as well. Either way, it's going down.
We're taking everyone down.
Taking everyone down with us. Drew Meredith, absolute pleasure. Thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.